think, first of all, this is going to be the largest U.S. IPO in history, one of the largest, on the scale of the Facebook IPO. So the important thing is the market's going to have to absorb a very big deal, and history shows that big deals can be hard to absorb in the market. Facebook's deal is a good example. And on top of that, investors have a particularly hard time with a company that is not earning money and has the scale of losses that Uber does. So investors are going to look at Uber and say, wow, it's like Lyft on steroids. It's got 5 times the revenue, but it's got 2 times the operating losses. Now, and also, Uber is decelerating in its growth. So I think that there are going to be question marks, even though Uber has the bigger platform, but it's spending a lot on that platform. I will say, on a positive note, Uber has put together a much better governance structure than Lyft. It has one share, one vote, one for each share, as opposed to the super voting setup that Lyft had. So I think that's a point in its favor. I will say the prospectus is set up to show there will be insider selling, and that is going to be a negative for investors that look at this. Why would insiders sell? This company needs money. It should not be selling shares by insiders on this IPO. They should wait.
David, why'd you invest in both?
Well, I think fundamentally, if you look at the needs of the millennials and the Gen Z, they're going to be 60% of the consumer. And they don't believe in owning a car. My son is 19 years old. He doesn't want a driver's license. He says, I'm saving you money, Dad, by taking Uber and Lyft instead of paying for parking and insurance. And so I think this macro trend of the younger generation diving into the on-demand economy, and Uber is basically king of the hill.
Kathleen, many different businesses here. It's a prospectus that has hundreds of pages to it, and no profitability in the foreseeable future, but lots of terms. So you've got gross bookings, take rate, core platform contribution margin, monthly active platform consumers, or MAPCs. A lot for investors to sort of digest there in terms of the key metrics that they should be watching. And does any of it really matter if you do have top-line growth across these biggest businesses slowing?
Profitability definitely matters, and that is going to be the issue in figuring out what is Uber worth. Now, we have a very good comp in the marketplace, Lyft, now trading 15% or so below its IPO price. Investors are not going to just ignore that comp when they look at Uber, even though Uber's the bigger company. And so Lyft is not traded well, and it's going to be incumbent upon Uber to set a valuation based upon, in this case, we'll have to look at just sales and some gross profit metric. It will have to be at a good discount so that the shares get absorbed into the market, get a lift on the IPO. It cannot structure a deal that breaks the IPO price, and conditions are different. The owners of Uber right now are many of the firms that buy shares in IPOs, Fidelity, T. Rowe. So they have to find, Uber has to find a whole set of owners to agree on a valuation in the marketplace. That it's going to be a big job to set the right price on this. And as I say, if you're selling shares, insider shares as well, I think there's going to be some pushback on that.
Yeah, Dave, this is a really interesting point, David. I wonder, there's a ton of variables for any new issue, but to Kathleen's point, we've talked for years about these companies that have been able to stay private for long because there was a bunch of dry powder in venture capital. Is the time in which they've spent being private another variable that investors should consider once they come public?
Yes, but I think it's a net positive. When you look at when Amazon went public in '97, it was a $500 million market cap. In '99, when they were about Lyft's revenue size, about $1.6 billion, it was losing $700 million, but the market cap was $28 billion, which is much higher than Lyft's valuation. And so I think because these companies are going public at a more mature, larger revenue-based stage, I believe it's actually a safer IPO than probably investing in Amazon in '97. Fundamentally, Uber is a very different company from Lyft. Uber is more of a horizontal play. It's going into food. It's going into trucking. It's going into virtual kitchens, and it's more international. Right. And Lyft is more of a consumer transportation play, and Uber wants to own the entire horizontal base of the on-demand economy. Much the way Amazon has, grown from bookstores to selling anything.